Money Sense, bringing an informed financial perspective to the Cayman community.
A very good morning and warm welcome to Money Sense. Your hosts this morning are Christoph Barnett and myself, Simon Caudry. We're delighted to be joined in the studio this morning by Des Kinch. Des is the founder and CEO of Overseas Asset Management, which is an investment management firm located on and run from Grand Cayman. Des, thank you very much for joining us this morning.
Thank you, Simon.
So Des, perhaps before we go into some in-depth analysis of where we are in the world economically and financially speaking, perhaps you could just give us a little bit of background as to what Overseas Asset Management is, how long it's been around on the island, because it may not be familiar to a lot of our audience.
In 1989, I was at the tender age of 26. I was working for one of the very early hedge funds in the world. It was a Luxembourg fund. Managed by someone I knew living in Monaco. I was working as an analyst for him. I'd previously worked for one of the banks and trust companies in Cayman. And I decided that I wanted to set up my own investment management business, managing money primarily for high net worth individuals who had money with banks or trust companies in Cayman.
And so what sort of strategies do you tend to invest client money in? Where's your area of focus? Because I think what a lot of people think of is they think of the investment industry as just one thing. And in reality, what it is, it's a collection of people with focuses and specialities in different areas. So just curious as to what your area is then.
I was always involved on the equity side. Equities are shares of businesses listed on stock exchanges around the world. And when I set up Overseas Asset Management, I focused on equities. Over time, it evolved. Initially, we had a global mandate. Then, between about 1989 and about 1996, 97, we invested probably about half of our clients' money in U.S. equities, the rest elsewhere. Quickly came to the realization that the U.S. stock market was extremely competitive. It was very difficult to beat the indices and add value. We had a lot more success adding value in Europe and Asia, and found some specific niches, such as closed-end funds that were trading at big discounts to their net asset value. I'll just explain quickly what a closed-end fund is. A closed-end fund is launched with a fixed number of shares at a price, let's say at $10 a share. And let's say 5 years later, the net asset value is $15 a share. But for whatever reason, there may not be demand for those shares in that company, in that fund, or it has become completely obscure. And even though the net asset value is $15, it might be trading at $9 a share. That we saw as an opportunity, and we would go out and buy shares of the fund with $15 per share of net assets at $9, build up a big enough holding, and then quite often agitate to try and realize that the net asset value per share. So that was one of the things that we did, and then over time it evolved, and we added other mispriced opportunities as they arose.
Would that be something then that people would hear and use the word arbitrage? That's something that's used in financial jargon quite a lot. Is that kind of what you're talking about?
Yeah, there is actually a term, closed-end fund arbitrage.
And does that sort of stuff exist now? Because I guess what a lot of people read about, particularly nowadays with respect to high-frequency trading and how the little investor is competed away by those with the fastest computers and all the rest of it. Is it actually possible nowadays for the average investor to find these arbitrage type of opportunities?
And so certainly in the closed-end fund world, yes, it is. But it's not in the US. It's in other markets.
Outside of.
Yeah.
So to turn into outside of the US, and it's one area which I think is taking a lot of, or generating a lot of interest from investors. When you look around the world and you see political chaos existing in certain countries, whether it be Russia, perhaps in Brazil and such like, and then you say, well, what should an investor do about that sort of thing? If you've got political chaos and you've got stock markets that are very weak, how does one rationalize? Are those emerging market areas, are they places that investors should be thinking about investing? Are they places that you would caution people from investing in? Where would you draw the line on that?
I think they're at the moment, particularly, I think there are tremendous opportunities in emerging markets because emerging markets have, certainly in terms of price levels of the indices in those markets, have been not emerging but submerging. And lower prices bring great opportunities. There is a company in Boston called Grantham Mayo von Otterloo who have a website, gmo.com. And every 3 months, GMO publish their estimates of asset class returns for various asset classes. So for U.S. equities, for international equities, emerging market equities, U.S. dollar bonds, international bonds, cash, etc. And at the moment, the only major asset class for which they have a reasonably positive return expectation for the next 7 years is emerging market equities. And I've been following their forecast for about 15 years, and they're usually pretty spot on. And you go back and you look at what they were forecasting 7 years ago, and at any point, and their forecasts are usually certainly in terms of the order of attractiveness of the asset classes, they're usually right, and quite often in terms of the actual projections of what those asset classes will return.
So should we go and sell all our U.S. equities and invest in emerging?
I would not necessarily do that, but what I would caution is that there is a time to take risk, and there's a time that it's not worth you're not being paid to take the risk. In terms of U.S. equities, there's a famous professor at Yale University, Robert Shiller, who wrote an excellent book about more than 15 years ago, probably about 18 years ago, called Irrational Exuberance. And he came up with something called the Shiller PE, Shiller Price Earnings Ratio, also known as the cyclically adjusted PE. And the cyclically adjusted PE for U.S. equities, which he actually publishes on his website and has all the historical data going back 135 years. The cyclically adjusted PE for U.S. equities is currently 27. The norm is about sort of mid-teens. So you could say sort of 15 or 16 is about where it is the middle of, is what might be regarded as fair value equilibrium. The cyclically adjusted P has only been above 27 on 3 occasions in the last 135 years. Once was in the first 9 months of 1929, and then we had the Wall Street stock market crash followed by the Great Depression. The U.S. stock market fell by 85% from 1929 to 1932. The other occasion was for 4 to 5 years in the late 90s, sort of 2000, which was the technology, media, and telecom boom. And the stock market fell nearly 50% from 2000, March of 2000 to end of 2002. The NASDAQ index, which was the sort of technology-heavy component of the market, which accounted, and technology, media, and telecom, those 3 sectors accounted for 40% of the value of all U.S. stocks at the peak in early 2000. The NASDAQ index fell by nearly 80%. The third occasion that this happened was for 1 month. I think it was in June 2007, which was an absolute market peak, and it preceded the global financial crisis when the U.S. stock market subsequently fell by more than 40%.
So Des, just before, this is breakfast time, and everyone's enjoying their cornflakes and wanting to enjoy the day that's upcoming. Are you suggesting that we should be worried about a 50 to 80% decline in the U.S. stock market because of this type of signal?
I don't think it will be 50 or 80%, but I'm just the historical odds are not in your favor if you're an investor in U.S. equities, and I think there are far better opportunities elsewhere. The cyclically adjusted Ps of many emerging markets, and Europe are in the sort of low to mid teens. So you're buying companies outside the US, good companies, at half the valuations typically. And we currently do have a lot of exposure for our clients to emerging markets. I can run through a few specific examples if you'd like.
So I understand your point about the valuations being attractive outside of the US in emerging markets. When you look at the ratio you talk about, one may be in the teens and one's in the high 20s, and therefore that suggests that you have to pay an awful lot more for a US company than you're paying for the same earnings from a European or an emerging market company. The flip side to that, I suppose, is someone may say, but if I go and invest in an Indonesian, an Indian, and a Pakistan, a Russian, Brazilian company, I've got my exposure to what the government of the day in those countries may do, and there have been periods of time when expropriation and nationalization has happened. So how does one take that into consideration when making the judgment about investing in the more speculative emerging market arena?
The risks are almost certainly higher investing in emerging markets than investing in the US stock market, for instance. But there's a price for everything. The other point I would make is that you need to spread your investments geographically so that you're not overly exposed to any one market. Russia is a particularly risky market. There are a lot of companies there that are subject to potential government expropriation. We do have a few investments in Russia, but they're companies that have demonstrated good standards of corporate governance. They've looked after shareholders well. They have a return on equity, so return on the capital that they have invested of 20-odd%, which is exceptionally high on a global basis. And take, for instance, Russia's leading bank, Sberbank, which has more than 40% of retail deposits in Russia. Sberbank has is generating a 20% return on equity, which the likes, even the really well-run U.S. banks like J.P. Morgan would die to earn far less. The likes of Barclays or Royal Bank of Scotland, and Sberbank's trading on less than 7 times this year's earnings, and based on if you annualize the earnings for the first 7 months of this year. So we think that's a steal. Another example is Gazprom Neft, which is one of the biggest integrated oil companies that drills for oil as well as refines it and has service stations right across Russia. And you're paying $2 per barrel of reserves, and the likes of Exxon, Shell, BP are selling at about $15 per barrel.
But what you're saying is, although what I'm hearing from you is there are lots of attractive reasons to invest in these sorts of companies in terms of valuation, but you've still got to be cautious and careful with respect to acknowledging the additional risks that come from investing in companies in these types of countries. So don't find an attractive investment, but go in small steps into those sorts of investments. Is that what I'm hearing?
Yeah, and I would not encourage most of your listeners, for instance, to try and dabble in some of these things, because it requires an awful lot of research, and there are an awful lot of dogs out there that are not gonna treat your investment in their company with respect. And
I guess as an additional point as well, as soon as you go outside of investing in US companies, you also have exposure to currencies, and we've seen with even developed market countries, the UK exchange rate versus the US dollar, dramatic changes in very short periods of time, which can take away almost entirely or more the returns that you can possibly earn.
Yeah.
Well, we're going to take a short break, Des, and after the break, I'd like to quiz you a little bit more on European investing, and you mentioned that as being a potential area, and just get your sense and your thoughts on where Europe is now that the Brexit decision has happened, what it might mean for the banking industry, the rest of the continental European markets there, and talk a little bit more about markets. So take a short break, join us in a minute, and we'll continue our conversation with Des Kinch. Welcome back. In the second half of today's show, we're going to continue our conversation with Des Kinch about the economic risks facing investors and what to do about them. So, Des, before the break, you had speculated that you thought the US market in particular was an overvalued market and that there were better opportunities outside of the US. You talked about valuations as being a key determinant of how to assess make that sort of judgment. And you had mentioned Europe. Clearly, we've had a period of relative turmoil in Europe with the Brexit decision and what that might mean. And despite the Brexit decision, one might say markets have responded incredibly well. So what makes you so positive and comfortable investing in Europe when there are political changes going on? There are stresses with respect to the survival of the euro and such like. Why would an investor want to dabble in the European markets given all those events that are taking place?
I think the simple answer, Simon, is valuations. We manage a European fund. The average price-earnings ratio of the holdings in there is about 12 times this year's earnings. We also invest in that fund. We also buy closed-end funds, which I mentioned before. On average, the closed-end funds in our portfolio are trading at about a 35% discount to net asset value. So you're buying $1 worth of assets for 65 cents. And we have about 20%, just over 20% of the fund in family-controlled, very wealthy European families who have listed investment holding companies in Europe. And on average, they're trading at a record 50% discount to net asset value. So you're buying $1 worth of assets for 50 cents in such instances. So we think that it's valuation is the reason to invest in Europe. The other important thing to bear in mind is that a lot of companies, even though they may be domiciled in Europe or listed in Europe, a very substantial part of their earnings are generated outside of Europe. So they're not completely exposed to the slow growth of Europe.
Do you worry, though? There's almost every single day there's a headline which is European banks not making any money or banks being fined. How does a region like Europe grow when its banks aren't making any money and are seemingly not extending loans to companies to allow them to invest and such like? How you may very well have low valuations. So in other words, it looks cheap to buy, but where's the scope for those companies to grow their earnings if they can't actually raise finance from the capital markets and from banks in particular?
We tend to invest in companies that are debt-free, prefer companies that are debt-free or relatively debt-free, or which can access the capital markets by issuing bonds. Very few of the companies in which we've invested are reliant on bank financing.
Would you go as far as to say avoid the banking sector in Europe then? Is that
as an investment?
Yeah.
We own shares in 3 banks in our European fund. One is Sberbank, which I mentioned, which is by far the dominant Russian bank, 7 times bigger than its next competitor. The second one that we own is a bank that actually used to have a branch here in Cayman called Standard Chartered Bank. Standard Chartered Bank generates about 70% or more of its earnings in Asia. They generate another 20-odd% in Africa and the Middle East. So it's maybe listed in London, but it is primarily an emerging market bank. They are the principal competitor to HSBC in most of their markets. We think that HSBC, which is a venerable old bank, which was historically very well run, our view is that it's not as well run as it used to be. And Standard Chartered is now being run by Bill Winters, who I think is certainly one of the best bankers in the world. He was the number 2 to Jamie Dimon at JP Morgan in London. He left JP Morgan of his own accord. He was applauded by thousands of people on the trading floor at JP Morgan when he announced that he was leaving. Very well respected. I have a huge amount of respect for him, and he's done a very good job in turning around Standard Chartered, which is trading at roughly half book value. Most banks historically have traded at above book value, so we think there is there is quite a lot of room for capital appreciation.
So let's just dwell on that a little bit, because there may be people who are listening who say, well, what do you mean by book value? And then they go and do a little bit of research and they find that the likes of a Deutsche Bank is trading at 20% of book value, and you think, well, that must be even better value. So how do you make the distinction between something that looks cheap and something that's too cheap? How would you caution people to make those judgments?
Well, I think some of the danger with a bank is that a bank typically has assets of 10 to 15 times bigger than its equity base, so the shareholders' capital. So if you have only, say, 8% of your asset, 8% of your total assets is represented by equity, and the value of your assets falls by 8%, you have wiped out the bank. So you have to be extremely careful in determining the quality of those assets. I think my view is that Deutsche Bank has long-term structural problems. I think it's going to be very difficult in the Western world for banks to get back to the days of earning 15% return on equity, which I would regard as a sort of long-term target for the best banks. Whereas I think the likes of a Standard Chartered operating in India, Indonesia, China, Korea, Western Africa, is capable of getting back to that level of profitability. We also there's a third bank that we own shares in, which was also based in Cayman, called Close Brothers, and Close Brothers generates more than 20% return on equity and has consistently done so since the global financial crisis. It's an exceptionally well-run niche bank, and it's been a very good investment for us.
Yeah, you said that you prefer companies with zero debt, but in contrast, we've seen the governments around the world expand their debt levels, taking on, I guess you could say, a lot of the private debt after the financial crisis, and then continue to deficit spend in efforts to spur the economy. The central banks purchasing that debt, driving down rates to negative. So how do this low yield environment, negative rates, affect your investment process? And then, is there an argument that textbooks tell us that low rates means that assets are worth more? So is that part of the reason that U.S. assets have such high valuations? It's simply a function of the low interest rates?
Yeah, that is a very big part of the reason why U.S. equities in particular are currently being valued so highly. It's, you look around at the alternatives, cash yields nothing, bonds yield next to nothing. In fact, there are about $12 trillion of bonds globally with negative yields, which is to your listeners is very much an alien concept.
Should investors hold those bonds if they're yielding negative?
Quite honestly, I think anyone would be mad to buy a bond with a negative yield. But
just to be clear what we mean by that, because it basically means you invest $100 today, and you know in 5 years' time you'll be given back less than $100 with no interest.
Yeah, well, I can give you a concrete example. You can go out and buy today. You can go out and buy a 10-year German government bond with it's a zero coupon bond, so it pays no interest. There's no interest coupon on it, and you're going to pay today 101, and in 10 years' time you're going to get back 100. So you're going to get back less than today, less in 10 years' time than you've shelled out today, with no interest payments being made to you over those 10 years. But there are a number, because of what is known as quantitative easing, whereby central banks around the world, particularly the Bank of Japan and the European Central Bank, are going out and buying bonds in the market. It has depressed yields to artificially low levels, and there are also regulatory reasons for it. So, a lot of banks and financial institutions are being forced to, because of the way that their capital is counted, they're being forced into buying these so-called low risk investments.
We've talked about this on the show before. We've talked about the negative yields and what that means for investors. But perhaps what we haven't digressed then into or moved into is, will this ever end? In other words, we've gone from a period of interest rates relatively high to continually lower and lower, and now they're negative. Does it not just mean that interest rates are going to get more negative and more negative, or is there going to be a turning point? How will we assess what will cause that turning point to arise?
I think it's impossible to say when the turning point will be. What I would say is that the current situation is not sustainable. And if you go back to the late 1970s, early 1980s, you had interest rates of 15 or 20%. You had inflation running at sort of 12 to 15%. It felt like at that time that the world would never get out of the grips of inflation, and that inflation could completely run out of control, and you could end up in a situation where, like the Weimar Republic in Germany with hyperinflation. So when you're in it, it feels like, it's just going to continue ad infinitum. But capitalism cannot work unless you come back to some sort of what I would call orderly equilibrium. And at some point, the interest rate cycle will turn. I suspect that inflation will increase, and we will at some point, I would think in the next few years, if we haven't done so already, we will hit the bottom of the interest rate cycle.
So I appreciate your point that it's almost impossible to tell when the turning point was going to be. But what sort of warning signs would you be looking out for, and what sort of warning signs should our listeners be trying to spot or pay attention to as a signal that this is a risk? And I ask this in this context, which is a lot of people who have pensions on the island have a lot of bonds in their portfolio. Historically, bonds have been thought of as relatively low risk because you get back your capital at the end of the time, unlike equities where the company may not pay you anything. And yet bonds, as we know, are subject to massive losses if or when interest rates ever rise, potentially. So I'm curious as to what sort of warning signs should the investors who are listening to this try to keep an eye out for or watch for?
We're not. I've never tried to forecast macroeconomic developments in the future. In terms of what you would look for, I think a lot of it is policy driven. So you need to look at what the central bankers are doing. There may come a realization at some point that a negative interest rate policy simply doesn't work, that it actually weakens banks and insurance companies, weakens financial institutions rather than strengthens them, and it deters them from lending. It makes them unduly cautious. So I don't know what the turning point is. I'm just saying that I do not think that this is a long-term sustainable situation, and it's not an orderly equilibrium. Okay, well, we could probably talk about that particular subject as to what the implications are if it changes for a whole new show. But I'm afraid, Des, our time is up on this morning's show. So thank you sincerely for joining us, and it's been a pleasure having you on the show. Thank you, Simon.
So,
thank you, Christoph.
Christoph, thank you. As a final note before we leave, I wish once again to thank you, all of our listeners, and remind you that today's show can be heard as a podcast on the CFA Society Cayman Islands webpage, and encourage anyone who has a question or topic that they wish us to cover to please email us at moneysense@candw.ky, or to tweet us, I believe that's the correct terminology, at our Twitter handle, which is @MoneySenseRadio. And be sure to post or put any comments that you have on our Twitter account there. A final point, and we're on a personal note, yesterday was results day for a number of people on this island who have been taking the CFA exam, and this radio show is sponsored and hosted by members of the CFA Society here in Cayman. So I'd like to express my heartfelt congratulations to each and every one of those people who passed the exam after at least 3 years of literally hard labour and an unpleasant slog of studying and revising. It takes an awful lot of hours and a lot of commitment, so congratulations to each and every one of those people who passed the exam. With that, thank you once again. Goodbye, and please do join us in 2 weeks' time again for Money Sense. Thank you and goodbye.
Money Sense is brought to you with the support of One Trade X.